Hey, this is Demo Gonzalez with Heartwood Financial Services. Wanted to welcome you to our quarterly market update. Instead of sending it to you via email, I decided this quarter to go ahead and do a video. So I hope you guys enjoy it. It's the first one, so give me a little grace. Hopefully they'll get better. And they should be pretty short, about 5 minutes. And what we're going to do is we're going to talk about the markets, how things performed last quarter, how the economy is doing, and also kind of a preview of what's coming up here for 2019. I hope you enjoy it. Okay, the first chart here is the chart that shows all the returns of the different asset classes for the year. It actually goes back all the way to 2004. I know it's a little busy chart, so at the top I'll just give you a quick review of what's there. The top is cash at 1.8%. The next one down is fixed income, which was at 0. REITs at -4. High yield at -4. Large cap, which is basically the S&P, at -4.5. Small cap at -11. Commodities at -11.2. And then the next one is developed market equity, so international stocks, -13.4, and emerging market equities at -14.2. So as you can see, there was pretty much no place to hide except for cash last year, maybe bonds, but there you really made nothing. So it was pretty a lousy year overall. This little line graph here shows a mixture of stocks and bonds at about a 60-40, because of course we don't just own one asset class. So if you would have owned a 60-40 mix, stocks and bonds, you would have been at -5.8%. And it really doesn't sound too bad when you look at it that way, especially with all the drama that we saw during the year, especially towards the end of the year when we typically don't see as much drama. So it's I think a lot of people, when they see this, they realize, yeah, it was bad, but it wasn't as bad as maybe as I thought. So there's a quick update on how the market performed last year, and the next slides will be about the economy and moving forward. So this is the Fed funds rate. You might wonder, well, why in the world is this important? Well, this is going to make a big difference on capital markets and the stock market and the economy. And what you can see here is since 2015, we've been having the Fed raising interest rates. And so think of it like an anchor. As interest rates go up, it's going to make it a little harder for the economy to continue to grow. And so right here, we're at about 2.38 in the current Fed funds rate. And the blue line shows what the Fed is estimating they're going to do. But this brown line here shows the reality of what the market's pricing in. So there's a little bit of a disconnect here. The Fed says that they want to raise a little bit more, although recently they've been a little bit more dovish. The market is pricing in really a flat interest rate environment probably for the next year, maybe even two. Now this is the S&P 500 PE, forward PE ratio. And as you can see back here in 2018, early in the year, we got kind of high. Okay, we were getting closer to the upper range of the standard deviation for price to earnings ratio. But then it came down significantly. In fact, now we're below the average PE for the stock market. So the stock market is actually cheap. And so when you look at interest rates maybe staying low for a while, as you saw the previous chart about the Fed, and you see the prices being pretty attractive, you really don't have to have super earnings to make the stock market go up. So if we can actually get some decent earnings that are a little bit better than expected, we could actually have a pretty good stock market this year. So I'm actually cautiously optimistic. I'm not bailing out of things. I'm really holding on the way we're positioned at this moment. So hopefully this chart kind of helps you understand that positioning a little better. Okay, last chart, I promise. This chart here is actually super interesting. You could see all the way to 2009 how the S&P 500 is done versus the purple, which is the basically the international stocks. And so there's been a huge divergence. Domestic stocks have done much, much better. Now what's interesting is, first of all, you can see from the past, usually we don't see that big of a divergence. So maybe that's going to start to narrow, and they're going to start getting a little closer. Either the U.S. stock market's got to get worse, or the international stock market's got to get better. I'm more in the camp of the latter, because when you look at the international stocks, this part of the chart here shows you, the U.S. is at 14 or so in their price to earnings, which is the valuation. International stocks are at about 11.5, and so they're even cheaper. Now, international stocks do trade at a little discount to the U.S. historically, but they are much, much deeper in value than they have been historically. And then the cherry on top, if you can see the numbers here for dividend yield, international stocks are paying almost twice as much in dividends. And so even if there's not a big valuation change, even if things just stay the same, you're going to be picking up almost 2% more in dividends. So as you can see, this is why I have exposure to international, and I've been adding to the exposure in international because I think there is that transition now going a little bit more in favor of the international stocks. So finally, I'll leave you with this quote here. Ships don't sink because of the water around them. Ships sink because of the water that gets in them. So don't let what's happening around you get inside you and weigh you down, especially if you're watching a lot of news. They do tend to dramatize things. And so that's why I try to do the best I can to communicate as often as I can to my clients, so that you guys know what's going on. You hear, the more objective news of what's going on with the economy and the markets. And so that is it. I hope you guys enjoyed this video. If you have any questions, feel free to email me, give me a call. But most of all, I just want to thank you guys for a great 2018. Thank you for your trust in me and guiding you through all the ups and downs in this roller coaster ride. I really, really appreciate it. And again, give me a call, send me an email, and I'd be happy to chat with you about any of your concerns. Talk to you later. Bye-bye.